Hello and good morning. Welcome to today's webinar. Thank you so much for joining us. We're glad to have you as we discuss bonds. Today we'll be talking about investing in bonds, government bonds specifically, and we are hoping that you'll be thoroughly informed and entertained. So please share with all your friends. We're live today on Facebook and YouTube, and this broadcast will be made available on all our social media channels. For any questions, please drop them in the comment section, and myself and our team will do our best to get to them as much as possible. The more relevant it is to today's topic, the more better it is for us to get to it. Thank you so much. So I'll begin by introducing who we are. We are NCBA Investment Bank, a wholly owned subsidiary of the NCBA Group PLC. We are also licensed and regulated by the Capital Markets Authority, and we offer customized solutions to all our clients. And this includes advisory services, brokerage services, as well as investment management services. So if you need any of our services, the brokerage unit includes equity trading, research services. We trade also derivatives and fixed income, that is corporate and both corporate and government bonds. I will just give a brief introduction of myself. I'm Florence Kinyer-Colivers, a fixed income trader at the NCBA Investment Bank. I have been working in the investment industry for over 10 years now. I currently hold an MBA in finance from the USIU, that is the United States International University. I'm also a level 3 candidate for global securities offered by CC, which is the Chartered Institute of Securities and Investments. For more information about myself, you can just reach out to me personally. So again, welcome. Today we'll be talking about bonds. What are bonds? Yes, we've had so much about diversification through bonds. So in our agenda today, we'll just try and define the key terms so that you are able to follow what we are talking about when you talk about bonds. Also, we'll need to find out who are the participants in the bond market and what sort of bond markets are there. That will help us to come to structure and the pricing of a bond, just to understand how do we price a bond, and be able to know, in case I wanted to invest a bond, how can I tell its value? Then we'll take a look at the benefits as well as risks of investing in a bond and the opportunities available when investing in bonds. Stay tuned. We'll begin by defining what is a bond. This is a term that has been used quite often, but many of you might not know it, but it's simply just a loan. A bond is a debt. And for the case of government bond, the issuer is the person who actually receives money from the investor or the initial buyer and undertakes to pay the bondholder regular interest until when the bond matures, and then the issuer repays back the bondholder the money at a specific future date. So who's an issuer? This is the entity that is borrowing the money. In our case, for Kenyan government bonds, the issuer is the Republic of Kenya. And because the Republic of Kenya doesn't have a face, they go through the Central Bank of Kenya. So you will be seeing a lot of my reference to the Central Bank of Kenya, which is CBK. A face value is the principal amount paid out to the bondholder upon maturity. This is also the units or the amount of the coupon payments that are based on. Okay, so another term that we use for face value is nominal value or par value. I'll begin by defining yield to maturity. So what is yield to maturity? It can also be abbreviated as YTM. This is the overall interest that an investor earns when they buy a bond at a market price and hold it until maturity. It's normally used to calculate the price of a bond and has an inverse relationship with the price. So what do I mean? For instance, if the yield to maturity of a bond is equivalent to the coupon rate of the bond, then we say that that bond is trading at a par value, that is at 100 or close to 100. But if the yield to maturity is greater than or is more than the coupon rate, for instance, if you have a bond that is paying a coupon rate of 10%, and then the yield to maturity is at 11%, then we say that that bond is trading at a discount because its price is going to be lower than 100. If a yield to maturity is less than the coupon rate, then the reverse is true. The bond was trading at a premium because the price will be greater than 100, okay? So what is a coupon rate? This is the annual rate of interest that is paid out to the bondholder, and it's expressed as a percentage of the bond's par value or face value. So coupons of government bonds are normally paid out semi-annually, that is after every 6 months. So for instance, if a bond is issued in January, it will pay its first coupon in July, that is after 6 months. The accrued interest of a bond is the amount of interest earned on a bond once it's been paid out. So the accrued interest takes into account the value date, that is the date that the bond is being transacted, and when it started earning interest, that is from its last coupon payment date. So the accrued interest would be the period between the last coupon payment date and the value date of that bond. So there are two prices for a bond, that is dirty price and clean price. So what do we mean when we say dirty price? It's the price of the bond or the instrument when it takes into account, it doesn't take into account the accrued or the entitlement of interest. And therefore it goes up and down on payment dates. Okay, so the clean price is when the bond includes accrued the entitlement of interest. The difference between the dirty price and the clean price is the accrued interest. Issue number is a unique identification number or the title of a government bond. For instance, if you have a bond that is entitled IFB1 /2020/11, that means that this is the first infrastructure bond that was issued in the year 2020 and has a repayment period of 11 years. Okay, so I will explain further what infrastructure bonds and fixed bonds are. So, but the issue number is basically a unique identification number of that particular bond. So there are no two issue numbers that can be similar unless it's a reopening, which I will touch on as we go. What is a bond prospectus? This is a legal document that is issued by the issuer giving an overview of the bond being issued. What do I mean? Normally, this document will have the coupon interest, the rate of coupon, the maturity date, all the details concerning this bond. It's supposed to inform the investor so that they can make an informed decision. So we'll take a look at the participants in the bond market, and there are three categories. There's the investor, the intermediary, and the regulator. Now, I have chosen to use this hourglass to depict the bond market participants, especially on the investor side, because it has a similar connotation. You see how the hourglass is shaped. There's the sand at the top, which is heavier than the one that is at the bottom, and it trickles down slowly in the middle. So the key investors are banks, funds, and insurances. These are what we call institutional investors or professional investors. They form the larger part of the bond market investors. And we also have corporate investors, which can be, any firm like an accounting firm or a law firm, which would have some funds and they would want to invest in a bond. Now that forms a very small portion or allocation of the total investors in the bond market, specifically in Kenya. So the individual investors are normally at the bottom of the hourglass. Now, this is not to say that they're any less relevant, but most of the time I've encountered questions as to why is the implied yield of this particular bond different from the price that my bond is trading at. So the difference is because the people who actually create the demand and the supply of bonds are the institutional investors. That is the bank treasuries, funds like pension funds, insurance companies, and they move volumes. They are able to trade in billions, okay? So that's why they form the larger part of the investors. Now, the intermediaries are where we come in, such as custodians who are regulated by central bank and the capital markets authorities. These are the entities that offer financial services, such as the NCBA Investment Bank and other stock brokerage firms. Even fund managers fall under intermediaries, and they're all regulated by the Capital Markets Authority. For investment banks and stock brokerages, they're also regulated by the Kenya Association of Stock Brokerage and Investment Banks, that is CASIB. Then we have a very key intermediary, that is the Nairobi Securities Exchange. The exchange provides a platform for trading of these bonds. So they're very important and key participants in the bond market. They are also a form of regulator because they offer protection to investors. The purpose of a regulator is basically investor protection, okay? So we'll look at the different types of bond markets. There are just two bond markets. That's the primary market and the secondary market. So what are we talking about? What do we mean by primary and secondary? Now, the difference between the two is, with the primary market, we only have an auction. That is, investors can only buy into the bond, but there is no platform to trade or sell their bond because they get it through an auction, which is provided by the Central Bank of Kenya. As I'd said, the issuer is CBK. So during a primary market, then the auctioneer is the issuer, and investors are able to directly bid for the bonds directly from the issuer, which is CBK. Now, secondary market, unlike the primary market, it provides a platform for both buyers and sellers. As it says, it's a market. That's where the exchange, that is the Nairobi Securities Exchange, provides the platform for them to meet. Now, investors are able to trade through the secondary market. So in the event you're not able to hold your bond until maturity and you would like to sell it, either to be able to get some liquidity or to move into a different investment, then the NSE provides a secondary market for you to have an exit route to sell your bond. I'll begin by looking at the primary bond market, and we'll start by looking at the different types or forms of primary bond issues. Now, there are three key bond issues. They're not too different, so you have to be very keen and follow what I'm saying so that you can be able to understand the difference. There is what we call the new bond issue, whereby the bond being auctioned is actually auctioned for the very first time. Now, during bidding for such a bond, investors can bid either competitively or non-competitively. What does that mean? You can either quote your yield depending on the information or return that you are looking for as an investor during a new bond issue, or choose to, if you do not want to take the risk of missing out in case you are too aggressive in your bids, then you can go at what we call a non-competitive rate. So when you quote the non-competitive rate, which is abbreviated as NCR, then central bank will allocate a yield to your bond based on the average rate of the accepted bids, okay? Then the other type of primary bond issue is the reopening. And as it says, a reopen means it's a reauctioning of a previously issued bond. So it means that the bond being issued is not actually being issued for the first time. It could be the second or the third, but the same bond. For instance, in the event when the government is looking to possibly meet an outstanding amount of budget amount, and therefore they can come and reopen at a certain tenor of a bond, which is favorable for both the market and themselves. Now, bidding for this is also competitive or non-competitive. It depends on the investor and the amount of risk they're willing to take, or if they're really keen on a certain yield. Okay, so now those two issues are very similar. The only difference is the reopening means that the bond was previously issued at a previous time. Tap sale is also a type of primary bond issue. However, the tap sale is an immediate reopening of an issued bond that was not able to raise the targeted amount. And during bidding, it's strictly non-competitive and it's issued at the market price. For instance, if a bond is issued in the beginning of, say, November, and then the government is not able to raise enough funds, they could come back and issue a tap sale within the same month or even at the beginning of December. Then during such a tap sale, a period of sale is given so that the investors can send in their bids. However, their bids must be non-competitive. That is, you take the price that had averaged during the primary open, okay? During the new bond issue. Thank you. Let's see, how do I invest in the primary market? Myself as Florence. How do you invest as an individual in the primary market? I'll just sip on my cup of tea as we go. It's very easy to invest in the primary market. As you can see, the steps are just very simple. You begin by opening a commercial bank account. So you can open an account with NCBA Bank, and then from there, you have to open a CDS account with Central Bank. Now, you have to note that as an investor and you would like to participate in the primary market, then you would have to directly open a CDS account with Central Bank. That means you would need, first of all, to have a commercial bank account, as I said. Then log on to Central Bank's website. There's a form that is available, or you can pick it directly from Central Bank or any of the branches of Central Bank. Then fill the form and provide the KYC documents that are required. That is the Know Your Client documents, yeah? So it's the common ones, a copy of your identification or passport, passport size photograph, and of course the PIN for tax purposes. Then once you have been able to submit your CDS account opening form to Central Bank, you would need to actually go there or have it, if for instance you're in diaspora, have it sent through email and input an email indemnity and submit it to Central Bank. Once the account is opened, they would send you a confirmation. Then, how do I invest in a bond? Which bond? You'd have to look for a bond prospectus. That means you'd need to be on the lookout on Central Bank's website to see the upcoming issues. Now, for the first several months, Central Bank has been very gracious to do more than one auction or more than one issue during every auction. So we normally have at least dual papers, dual bonds issued. That means you could get one that is short-term and another one that is long-term. This is supposed to help an investor who is looking at different strategies, whether to invest in a short-term bond or in a longer-term bond. And I will explain later how that is relevant to you in deciding whether you want to go in for a longer bond or a shorter bond. They all have different aspects of risk and return. Once you have locked in on the bond prospectus and you've read the specifications of the bond and you're keen on that particular bond, that is as an investor, you would need to submit your application form to Central Bank and apply for the bond. As I had said earlier, if it's a tap sale, then you have no choice but to accept the non-competitive rate. However, if it is a reopen or a new bond issue, you have the discretion as an investor to choose at what rate or yield that you would like to invest the bond in. And then central bank has the discretion of either accepting or rejecting your bid. Once all applications have been sent during the window of the period of the opening period that central bank has stipulated, central bank will then release auction results. And then this is where, as an investor, you have to look out again on the website and wait for the auction results. Here in Kenya, auction results normally come out Thursday evening or Friday morning after an auction of a bond. And the auction results will tell whether there were bonds that were successful or rejected. Then you would need to liaise with your bank, remember, the commercial bank that you opened at the very beginning, in order to, in the event you were successful in getting your bond, you would need to then debit your account and credit central bank's account upon value date of the bond, okay? That's the date when the bond begins to accrue interest. Now, how do you get your results? If you have an email indemnity with central bank, you would be able to communicate to them on email, and they would confirm whether you were successful or unsuccessful on your bids. However, if you do not have an email indemnity, then you would need to liaise with your bank to do this for you, okay? So what does the bond auction process look like? We're going to take a look at a sample prospectus. I've talked about the bond prospectus, but then what does it entail? And we'll look at this particular bond prospectus. Hold on. I hope you can see. So this is a sample prospectus of a formally issued auction bond in September 2020, and it says the prospectus for reopened 15-year and 20-year fixed coupon treasury bonds. So if you look at the title of these particular bonds, they begin with FXD. Already that should tell you that this is a bond that pays fixed coupons, okay? So FXD2/2010/15 is the second issue of a bond, a 15-year bond issued in 2010. Then FXD1/2020/15 is the first issue of a 15-year bond issued in 2020. Now, note that initially it says it's a reopened 15-year and 20-year bond. That means that these two bonds, FXD2/2010/15 and FXD1/2020/15, had previously been auctioned, and now this is a reopening, okay? Then there is the FXD1/2011/20, also the first issue of a 20-year bond issued in 2011. So since we're in 2020, this is obviously a reopening as well. And we'll look at the specs. So central bank, on behalf of the Republic of Kenya, is looking for a total value of 50 billion shillings. So that it's calling for, this prospectus is supposed to be calling investors to be able to raise up to 50 billion shillings. Now, if you come to the next page, you will see there is a schedule that shows the yield and the clean prices. Remember, when we were defining terms, we talked about dirty price and clean price. And this here shows the clean price at specific yields for this bond. So in the event, as an investor, you wanted to, for instance, invest with and get a return of 10% for the FXD2/2010/15, then your price would be 95.975. Okay, so that's the indicative. If you were to be successful for this bond, then this would be the price. However, if you were looking for 10% same return, But on this longer bond, which is FXD1 2020-15, then the clean price would be 120.794. Reason being, if you look down here, there is a specification of the accrued interest for each bond. Okay, so for the 15-year bond, which is the FXD2 2010-15, it says the bond attracts accrued interest of 2.423 for every 100 shillings. Withholding tax is computed on the clean price. Now, we'll talk about the withholding tax, don't worry. It gives an example. For instance, if the quoted yield is 9%, then your dirty price would be 99.975. Can we see that at 9%, the clean price is 99.975, and therefore your dirty price would be plus accrued interest, which is the 2.423, and the dirty price would total to 102.398. Can you now see the difference between clean price and dirty price? As I said, the difference is the accrued interest, okay? So this schedule is just, by central bank, is just to allow you to be able to see indicatively what you would, to calculate how much it would cost you to invest in this bond if you were to bid at that particular yield. Now, this is only for new issues and reopenings. That's where you get such a schedule. Like I said, for a tap sale, it's a fixed price. That's the market price. Therefore, if you were to go in, that is bid for it, it would be at a non-competitive rate. Okay, so we'll go to the next page of the prospectus. And here we are able to see the specs or the specifications of this particular bond. So if you see at the top, it says Central Bank of Kenya, acting in its capacity as fiscal agent for the Republic of Kenya, invites bids for the above bonds whose terms and conditions are as follows. Remember, this is a legal document. So as we said, the issue is the Republic of Kenya, and the amount that the government is looking to raise is 50 billion for the purposes of supporting its budgetary spending. Now, the specifications of the bonds begin here. The FXD2/2010/15 is actually a 5.3-year bond. Why? Because it was issued in 2010, and now we are in 2020. So already it has covered 10 years. So it's remaining with about 5 years to maturity. So note, though it's the second issue of a 15-year bond issued in the year 2010, its actual tenor to maturity is 5 years. Now, the FXD1/2020/15 has 14.5 years. Since we said it's a reopening, it means that this bond was actually issued earlier in the year 2020 and is only remaining with about 14.5 years. And if you look at the lower, it specifies the coupon rate for each bond. So for the FXD2/2010/15, the coupon rate is 9% per annum. For instance, if you were to invest in 1 million shillings of this bond, then annually you would be getting about 90,000 shillings. But since it's paid semi-annually, you would be earning 45,000 after every 6 months. Okay? FXD1/2020/15 has a coupon rate of 12.756% per annum. Now, we are going to see how the relevance of the coupon rate and the yields to maturity, how they relate. If you remember, I mentioned when the yields to maturity is greater than the coupon rate, then the price tends to be lower than 100, and it's said to be at a discount. However, if the reverse is true, if the yields to maturity is less than the coupon rate, then the price will be higher. That's the relationship between the yield and price. When the yield is lower, or rather when the yield goes lower than the coupon rate, the price goes higher than the par value, which is 100, okay? So for these bonds, for the purposes of this webinar, we'll look at the FXD2/2010/15, which here says the coupon rate is at 9%. Now, I'll just go back to my previous slide so that you can see what I was saying about the price. So at 9%, at 9%, the price is at 99.975, which is very close to 100. And the only discrepancy is because this is a reopening. So it's not, there's accrued interest, there's interest that has already accrued, okay? So at 9%, then you have a price very close to 100. And should the yield be greater than 9%, say for instance, at 10%, you can see the price goes down to 95. And if the yield is less than 9%, which is the coupon rate, say 8%, then the price goes up to 104. I hope you can now see the relationship between price and yield to maturity, okay? Great. You know, one of the things about doing a webinar is that you're not able to hear the response of your audience, but I'm sure you're following. If you have any questions, please feel free to put them in the comment section. We'll get to them as soon as we can, okay? Let's continue. So we've seen there is the coupon rate. Then the other thing that the prospectus has is the period of sale. This is very important for you as an investor to note, because then you will not miss out on the bidding period, okay? So the period of sale is when you are allowed to send in your bids, after which the auction will be closed and none of your bids will be accepted. So for this purpose, this September issue, the period of sale was between 31st of August to 15th September, which is about roughly 2 weeks. So you see you have a window of 2 weeks to put together your finances and decide on what return based on the information or market intelligence that you get from your financial advisor or any other form of information that you have concerning the government bonds of this particular tenor. Then the value date is the date when the transaction will be completed. That means you will, as an investor, would have to debit your account and credit it to central bank. And that's when, upon receipt of your bond, you would start accruing interest, and and you would be entitled for the accrued interest. Okay. So for this case, the value date was 21st September 2020. So note the period of sale was between 31st August to 15th September. Then, after which there was a closed period from 15th September until 21st September. Now, the price quoted can either be at a discount, premium, or par. We have talked about this. The minimum amount investable for the bond is 50,000 Kenya shillings, okay? And you will see as we continue that these bonds are normally tradable in lots of 50,000 shillings. So you cannot sell a bond of 51,000 shillings, okay? It can either be 50,000, 100,000, 150,000. It's lots of 50,000 shillings, unless for a very a specific bond, such as infrastructure bonds, which tend to have partial redemptions. And we'll look at that, okay? So on the taxation, discount or interest is subject to a withholding tax rate of 10% for the 3 bonds. Now here in Kenya, withholding tax is charged on the interest, the bond interest, not on the maturity of funds, okay? But on the bond interest. And if you look at this bond, so the rate is 10% for the 3 bonds because they are 15 and 20-year bonds. So in Kenya, bonds that are longer than 10-year periods attract a withholding in tax of 10%. However, shorter term bonds attract a withholding tax of 15%. And the only bonds that are tax exempt are infrastructure bonds, and they're normally entitled, or rather when their unique identification number begins with IFB, okay? So the issuance method is multi-price bid auction. The non-competitive bids are at a maximum of 20 million shillings. So for instance, if you want to bid, but at a non-competitive rate, the maximum amount you can do that with is 20 million shillings. For instance, if you have more than 20 million shillings, then you would need to actually bid or give a competitive bid for any additional amount more than the 20 million shillings, okay? So as I mentioned, the bid's closure date is after the period of sale, and in this case, it was 15th September, 2 p.m. on Tuesday, after which no more bids are accepted at Central Bank. Then the auction date is the following day, which is Wednesday, 16th September, and that's the day when the Central Bank comes. There's normally a bidding box, an auction box, where you drop your application for the bonds, and then they are sealed after the bid's closure date, after which now Central Bank opens them on the auction date to review the bids that have been put through, and then analyze and see how much they need and at what rate are they willing to accept, after which they calculate an average and send out the results. So results, we are here on results. Investors should obtain details of amounts payable for successful bids from Central Bank of Kenya on the 17th of September. So after auction date, you are allowed to request Central Bank to send you a report of whether you are successful on your bid or not. Should you be successful, then you would have to make sure, liaise with your bank and make sure that funds are debited on value date. If you remember, that's the date of the transaction. Okay, so the prospectus goes ahead and says that defaulters may be suspended from subsequent investment in government securities. That means you are not allowed to bid and then fail to pay for the bond if should you be successful on your bid. Commissions, licensed placing agents will be paid a commission at the rate of 0.15% of actual sales at cost of 5% withholding tax. Now this one only relates to intermediaries, so it should not concern you as an investor. What does rediscounting mean? In the event you are unable to hold your bond until maturity and you cannot find a buyer in the secondary market, then the last resort is to go back to Central Bank. And here, the prospectus says the Central Bank will rediscount the bonds as a last resort at 3% above the prevailing market yield or coupon rate, whichever is higher. That means you would be selling your bond back to Central Bank at a very great loss, okay? It's highly discounted. For instance, if you bought your bond at 10%, then you would be selling it back to them, say for instance, at 13% or 14%, which is a much lower price, okay? All right, so liquidity. The bonds qualify for statutory liquidity ratio requirements for commercial banks and non-bank financial institutions. Now, all these are details also for the agents or intermediaries. And the key thing for you as an investor to note is the reopening date, which, yes, the bonds may be reopened at a future date, and secondary trading in multiples of 50,000 commences on 22nd. So the value date is 21st September, and then the following day, 22nd, your bond, if you wanted to sell immediately, you can sell it. Central Bank reserves the right to accept bids in full or part thereof or reject them. Therefore, like I said, the discretion lies with Central Bank as to whether to accept or reject your bid. Now, that was the prospectus. Once you have already sent in your application. If you remember, we said you've identified the bonds using the prospectus and you've submitted your application form to central bank. So what are you waiting for? The auction results. So central bank will post a document like this that is currently on your screen, and it says reading the auction results. So the results will be a summary of what was accepted and what was rejected. Let me just increase the size. So the details that you're looking out for is, at the very top row, due dates is the maturity date for the specific bonds. Okay, so this is FXD1 2025, FXD2 2018-10, FXD1 2019-15. So FXD1 2025 is the first 5-year issue issued in 2020. And then FXD2 2018-10 is the second issue of a 10-year bond issued in 2018. And if you look, the maturity date is 2028. A way of easily calculating this is just looking at the last digits. So if it was issued in 2020/5, it's a 5 years, so it's 20 plus 5. It's maturing in 2025. If it's 2018/10, then it's a 10-year issued in 2018, so 18 plus 10 is 2028. And in the case of 2019/15, it's a 15-year issued in 2019, so then the maturity date would be 19 plus 15, which is 2034, all right? But of concern, like I mentioned, is the total bids received, or rather, and accepted. So you would be looking at, this issue was supposed to raise 60 billion. However, central bank received much more, a total of actually 181 billion from the 3 issues. And what was accepted was only 80 billion. Okay, amounts accepted. For the 5-year, it was 9 billion. For the 10-year, it was 21 billion. For the 15-year, it was 50 billion, totaling to 80 billion. So that tells you there was a very high rejection rate, because out of 181 bids that central bank received, they only accepted 80 bids. So what do? You come and look at the yield that, the average yield that was on the accepted bids. So here, what you're looking for is the market weighted average rate. That's the average rate of all the bids. But what you want is the weighted average rate of accepted bids. So that if you had actually gone at a non-competitive rate, this would be the yields at which you were successful on. So for the 5-year, it was at 10.26%. The 10-year was 11.45%. And the 15-year was at 12.34%. The coupon rates you already know from the prospectus, okay? So judging by this, you can then send, if you had already gone in at non-competitive rate, you can now liaise with your bank for the transactions. However, if you had gone in at a competitive bid, you would need to liaise with central bank just to give you a confirmation of whether you were successful or not. So this is just a small summary of what auction results table look like, okay? So far we have seen the primary market, and now we're going to take a look at the secondary market. This will be more interesting, I guarantee you. When you talk about the secondary bond market, as I mentioned, it's a platform where both buyers and sellers meet. So the NSE, that is the Nairobi Securities Exchange, provides this platform. And this is a schedule, I know it's looking fuzzy, but I will break it down for you. It's a schedule of implied yields, which is provided by the NSE on a weekly basis. You can actually subscribe to be getting it on a weekly basis if you're very interested. However, your financial advisors can be sharing this with you. Okay, so we have over 60 bonds that are outstanding in Kenya. What does that mean? That's good news for you as an investor. It means you can be able to get specific returns and specific bonds with different maturities that meet your need if you wanted. There is a variety to choose from, in short. So this is a schedule that shows the implied yields, and it's prepared by the NSE on a weekly basis. It's just an average. What it does is it shows an average of the price where the bonds have been trading on the exchange. Unlike the stock exchange, or rather, unlike stocks, that is equities, whereby you are able to see the pricing every day, bonds normally, as you've had, they move a lot of volumes. That is, they trade in millions and billions, and they don't all trade at once. It depends on the demand and supply. Therefore, the platform on which it trades is only available to the stock brokerages and investment banks. And therefore, with that, the NSE is able to collect data based on the performance on the trading platform for the week and determine the price of the bond. So we'll begin by looking at the first column, which has issue number. If you remember, that's the unique identification for the various bonds. So you would have, if it begins with FXD, remember that's a government bond paying fixed coupons. If it's beginning with IFB, then that's an infrastructure bond. Now, the difference between infrastructure bonds and fixed bonds, government bonds, is the tax issue. So infrastructure bonds are exempt from taxation, whereas bond interest on fixed bonds are dependent on the tenor. So the shorter tenor is 15%, and the longer tenor, that is longer than 10 years, is 10%. Now there's something called ISIN code. Notice the letters KE 5009430. That's just, it's an ISIN code, which is an identification that is used during trading by the intermediaries, such as brokers and investment banks. So it's not really for you as an investor. So you do not have to be keen on that. Now, the other thing to look at is the issue date. So the implied yields normally have a very detailed specifics about the bonds. So the specific bond with its issue number comes at issue date, and it shows you the last coupon payment date. So for instance, we'll take the FXD one, 2019-15. The last coupon payment date for this bond was July 27th, 2020. Therefore, since we said coupons or bond interest are paid semi-annually after every 6 months, the next coupon payment date will be in January 25th. This is so that you're able to plan your income flow. Then the maturity date is January 9, 2034. Remember what we said about 2019, 15-year bond, it's 19 plus 15 is 2034. So if it was issued in 2019 January, then it's maturing January 2034. The tenor to maturity is just the number of days outstanding before it matures. And then there's the column here which we're interested in, which is the implied yield to maturity. Now this forms, remember I said bonds, unlike equities, equities are priced using what we call the volume weighted average price, the VWAP. However, for bonds, the implied yield is exactly that. It's implied that this is where the bond has been trading, near where the bond has been trading. So you can easily find that this bond, though the implied yield is at 12.09, it has traded either at 12% or even at 12.1%, okay? Then it also indicates the clean price as of this date, September 4th, 2020. This is the implied yield for that date. It's issued every Friday. The NSE releases an implied yield, which is applicable for the following week. So for this one, the clean price was 104.939 with an accrued interest of 1.3775. Therefore, when you add the two, the dirty price is 106, okay? So in the event you want to buy this bond, you know that if you're going to buy 1 million nominal or face value of this bond, you would need at around 106 or 107 million shillings, okay? Sorry, 1.06 million shillings. The bonds, the nominal value is always calculated per value, per 100, okay? The price of a bond or the value of a bond is calculated per 100. So for instance, if you're buying 1 million nominal value at a price of 104, then it would be 1 million times 104 divided by 100, okay? So for this case, you know that you need about roughly 1,070,000, right? Yeah. Let's look at infrastructure bonds. If you notice, the infrastructure bonds are very few. That's because normally the government will issue an infrastructure bond to supplement the infrastructure, or rather, yes, to supplement the infrastructure project. So these are very rare, obviously, because government needs to raise revenue using taxes. So we don't have too many of them. But whenever they come, they are a favorite of the market. That is the banks, the insurances, individuals, local and foreign investors, they all love infrastructure bonds. And the reason being because of the tax situation, they're tax exempt, but also they tend to have pretty good returns after tax, when you compare it with a bond that has say 13% after 15%, sorry, after 10% tax, then you can see that they are worth comparing with. Then if you look at them, they have specific coupons. Remember, this is the coupon rate, the fixed coupon rate. So 12%, 12.5%, 11%, it depends on when the bond was issued. And we'll talk about timing when you're investing in a bond, because it's very crucial to understand the period or the economic period that you're in when you're investing in a bond, since the price is determined by its interest rate or yield, okay? Next, we are going to look at something called the yield curve. What is a yield curve? A yield curve represents the relationship between the yield and the number of years or of a bond, the number of years to maturity of a bond. All right, so it's used to compare bonds with similar tenors to maturity so that you can tell which one has a better yield. All right, so it's just a graphical representation, but it's very key in understanding how yields move. For instance, look at the shorter bonds, the shorter term bonds, that is less than 5 years. The yield is lower than the longer term bonds. Why? Because of the relationship of risk versus return. So the higher the risk, the higher the return. And longer dated bonds are considered to be higher risk because a lot can happen, for instance, between now and the next 20 years. Currently, we are about to get into a change of leadership. We are facing elections in 2022, right? So between now and 2022, there's a lot of stability because we know who the president of Kenya is. But after 2022, then there is a bit of uncertainty. But you will see that when you're investing in a bond, there's something called, there's something that works for you as a bond, and that is uncertainty. When you invest in a bond, then you're able to lock in your regular flow of income for a longer dated period. Therefore, you do not have to worry what happens between now and the next 5 years or the next 10 or 20 years. The longest dated bond in Kenya is 23. It was issued in 2011. It was a 30-year bond. So yeah, it's about a 23-year bond, okay? Let's look at statistics on bonds trading. I've been asked frequently, which are the bonds that are trading in the market right now? And why I would like to buy a bond, which bond should I buy? Now, unlike the stocks whereby if you are going to invest in a Safaricom share, you understand that Safaricom's main job is communications. Now, bonds are very different from that. You do not just invest in a bond simply because it's trading at a higher, or rather, it's frequently trading, okay? And I'm going to show you why. If you look at these statistics, which were issued by the NSE in September 2020, the bonds that traded the most were these infrastructure bonds, as well as 2 fixed government bonds. However, the consideration shows you IFB1 2020-11 traded a turnover. Turnover is the entire value of the bond value that has been traded, which is 23 billion. And it traded at different yields. 11.3 was the highest yield traded, and the lowest yield traded was 10.2. The number of deals, that is the number of transactions, were almost 1,000, okay? But then just look closely, there is the IFB1 2029, which is a 9-year, the first infrastructure bond issued in 2020 with 9 years to maturity, traded a turnover of 8 billion. And the yield, the highest yield traded was 11%, and the lowest traded was about 9.6. But the deals were only 38. So what does that say? Volumes can be moved by only a few investors. As I mentioned, using the depiction of the hourglass, we have institutional investors who can move volumes. And just because a bond is trading a lot more, has a higher turnover than other bonds, does not necessarily mean that it's the best bond for you as an investor, okay? So when you're investing in a bond, the key thing to look out for is your needs, okay? How much risk are you willing to accept, and what sort of return are you looking for? You could, for example, if you have a young family and your children will be going to school, or rather will be going to university in the next 10 years, so you're willing to take a shorter time, you're willing to take lower risk. That means go for a shorter dated bond. You'd probably invest in a 5-year or a 10-year bond. However, if you've retired or you do not have any kids in school, you've already finished raising them, and the money that you have is just yours, you can choose to invest in a 15-year bond if you're still young. Or if you're looking to leave it as an inheritance to your children, you can go for a longer dated bond. So you do not have to necessarily follow the trend or the herd in the market, okay? So I just wanted to show you that difference, that you could have, a bond could have a very high turnover, but the deals are very few because only a few investors have been trading in that particular bond. But you could have a bond that is trading even lower, but with many deals or many transactions, meaning the demand and supply is a lot. For instance, if you look lower, there was the FXD2 2018-20, which had 145 deals, okay? Which is much more than the previous one, the infrastructure bond, the 9-year infrastructure bond, which had 38 deals. That's just for you to note, okay? So far, I'm hoping you're liking bonds and it's beginning to make sense. We'll look at how a bond is priced. How do you know if you have gotten a good deal for your bond? So that you can be able to buy it or sell it in the secondary market. Now, this is a sample of a bond pricing. At the very top, you will have the issue number of the bond, and then it will show you the specifications of this bond. That is the date when it was issued, the date when it will be maturing, the date when it last paid its coupon interest, and when it's expected to pay its next coupon interest, as well as the trade date and value date, which could be the same or have a difference of 1 to 3 days. Okay, so in Kenya, bonds can settle on T+0 up to T+3. That means on trade date until once the bond is traded, it is given at least 3 days for it to settle. However, that has to be agreed between both the buyer and seller. If the seller needs to receive money on the same day that the bond is traded, then the trade date and the value date will be the same. There is the coupon rate, which also shows the interest which the bond is earning every year. And then the nominal, which we normally say is the face value of a bond. It can be, for this purpose, we put 100, but it's never 100. It's about 50,000 or lots of 50,000. So you have 5 million, a million, 500,000, 100,000, etc. Okay. Then the yield to maturity is the one that is used to determine the clean price of the bond. And if you remember, we said about the yield to maturity, if it is higher than the coupon rate, then obviously the price will be at a discount. If it is lower than the coupon rate, then the price will be at a premium. The dirty price will be indicated there based on the yield to maturity. The accrued interest will also be indicated in the pricing so that you are able to tell how much interest has this bond accrued, okay? By the time you're buying it. Say for instance, if you're buying it when it has already paid interest last month, which was October, then you would want to look for a bond that the dirty price and the clean price are not so high. What do I mean? Already the former bondholder or the seller has booked their interest, okay? The semi-annual interest. So you would want a favorable price. That's just what the accrued interest there is supposed to help you with. Then the face value for this is, like I said, 10 million, which is the 10 million here is the holding amount of that bond. So which the interest payments will be based on. Okay, so it's the nominal value or the face value. Now, at the top where I'd said nominal, it's because for every unit of bond stock, sorry, that is, for instance, a 1 million or 50,000, then the pricing is based per 100. So if you have a pricing of 110 for a million stock, a million bond stock, then the price would still be 1.1 million, okay? Because you divide by the nominal 100. Okay, consideration is the amount or the value of the bond after dirty price, okay? So if you have a face value of 10 million and the dirty price is 110, as I said, the consideration would be 11 million. Then you have to look out for charges. In secondary market, you are not able to go directly to the buyer or the seller. So you use an intermediary, and then the intermediary is what we call a broker. Since they're the ones trading, they will charge a brokerage commission. And then since this particular bond will be traded on the exchange, the NSE, then it will attract transaction levies, which are paid out to the various statutory bodies, such as the CDSC, the Capital Markets Authority, and the NSE. So it's a standard rate or a standard charge for the transaction levies. The brokerage commission is dependent on the broker. So for purposes of this explanation, we'll say the brokerage commission is 0.024% on the consideration. And then the transaction levies normally total to 0.011%. In the event there is VAT, the tax, it would be included here, okay? Once you have looked at the specifications of this bond plus the pricing, then you would need to know if you're the one who is selling their net amount receivable after all charges. So in this case, total charges are 0.035% of the consideration, which amounts to 3,854. However, if you're the one buying, then you'd look at the net amount payable, which is the consideration plus the total charges, okay? So that's the difference. If you're the seller, it's the net amount receivable is the consideration less all transaction charges. If you're the buyer, then the net amount payable is the consideration plus the total charges. What is the process of investing in the secondary market? Step one is to open a CDS account with central bank. At any given time, central bank is the sole custodian of government bonds. So you have to have a CDS account with central bank as an investor. However, we'll talk about the various channels that if you are not able to go directly to central bank, how else you can be able to still invest in bonds without necessarily opening a central bank CDS account. But for the purposes of you as an individual investor and you want to have your own bond portfolio, then you would need to open a CDS account with central bank and then open a brokerage account, for instance, with NCBA Investment Bank. So the key parties here that would be working would be you as the investor and the bank. Then once you've opened this central CDS account, then you would need to consult your broker on the available bonds in the market. You'd need to talk to your financial advisor and determine which bonds are suitable for your needs, depending on the risk that you can accept as well as the return. Then once you have zoomed in on which bond you want to buy or sell, confirm pricing. So your broker would send you a pricing, which would be showing you the yield at which you're buying or selling the bond, the date that it would be traded, as well as the nominal amount and the total amount payable or receivable. Then the other thing that as an investor you need to know is the broker should also confirm the counterparty, okay? So once you have established the pricing, then you would need to look at your account. If you're the buyer, fund your commercial bank account and then sell. If you're the seller, you would need to give instructions to your bank to avail the bond. What do I mean by availing the bond? Remember, the bond is held at central bank. So you would need to instruct central bank to make your bond available to your broker for them to sell it. The last step, once the bond is traded, the broker would execute it and then settlement would take place using the banks, that is the buyer and the seller's bank. Money would move from the buyer's bank to the seller's account, and the bond would then move from the bank, the seller's CDS account at central bank and move to the buyer's CDS account at central bank. It's as easy as that. The process of investing in secondary market is just 5 steps, okay? Now, I love this quote by Warren Buffett. He's, he's a renowned investor in this globally. And it says, uncertainty actually is the friend of the buyer of long-term values. What does that mean? If you're going to invest in a bond, you do not want to be a speculator where you go in and come out, because you will end up making a loss. And we'll see how. However, if you're willing to wait the long while, then whether or not there's uncertainty, you will keep smiling because you'll be having your fixed regular income as a bondholder, and you can be able to plan for the maturity of your bond. Common rule of thumb, as I said, never invest in an asset you do not understand, okay? Well, this is the purpose for this webinar, is to help you understand bonds better so that you're able to make an informed decision when investing in a bond. However, if you're not able to comprehend what's going on, please do not invest in that asset, okay? I would say always consult with a financial advisor before you decide on which security or bond you would like to invest in, so that you do not end up making an uninformed decision which would result in losses, which would be very unfortunate. A balanced diet. I love food, so I had to say that. Don't put all your eggs in one basket. What does that mean? Just like when you're talking about stocks, we've talked about diversification, And bonds is a way to diversify your investment portfolio. Do not put all your money in one bond. And then also, the other extreme applies. You cannot go investing in all the 60 bonds. You would love to be able to invest your money in 2 or 3 different bonds that you can be able to keep track of its interest payments as well as maturities or partial redemptions. Assess your risk. The higher the yield, the higher the risk. So if you're willing to take on more risk, then good for you, because you can be able to get a higher return. But also, there's also a risk of higher losses. But then that's where you need to talk to your financial advisor. Pay attention to costs. Read your bond prospectus and pricing thoroughly. I cannot overemphasize that, because costs can eat into your return. When you are investing in a bond, you would want to ensure that if you're selling it, you're not selling it at a loss. And that means looking at the total cost, inclusive of any charges, okay? Give your investment time to grow. Allow it to grow. Like I said, uncertainty is the friend to the long-term investor, okay? So please don't be in a rush to buy or sell a bond. You will burn your fingers. Any builder will tell you they have to count their costs. My husband is in the deals with structures and buildings and is always talking about costs. So it's not any different when it comes to financial assets like bonds and stocks. You have to analyze the risk and benefits. And that means you have to understand what affects the pricing of a bond. As we said, the yield determines the pricing of a bond. So what really affects this yield? Interest rate movements. Where are the interest rates going? How do you tell if this is a good environment to invest in a bond? Last year, we had what we call the interest rate cap repealed, or rather removed. And one of the things that many people who possibly have interacted with banks when borrowing a loan, or just trying to understand if what the loan rates are, is you will tell before the interest rate cap, the loan rates were as high as even 20%. Now, that's a very good indicator, because if banks are lending to you at 20%, then it means that they're investing their money somewhere where they are able to make that return, or fairly as much. So in the event where you expect that the loan rates are about to go down, there's always a likelihood that the interest rates or the yields of the bonds will also be going down, okay? They have a way of going hand in hand. The other thing is the rate at which banks are lending to one another. Now, this might be difficult for you as an investor to know. However, if you follow central bank's website, you can look at something they call the interbank rate, which they always post on their website. And depending on how the interbank rate is going, if it's going up or it's going down, that is, if interest rates are on an upward trend, then there's a likelihood that the yields of a bond, especially on the short term, would be going up. Now, if yields are going up, that means the price of your bond is going down. The value of your bond portfolio is going down, and that's not a good time to sell. However, if yields are going down, that is, the interest rates are moving lower and lower and lower, then it means your bond portfolio is increasing in value. And depending on whether or not you would like to take profits or wait until maturity, you can choose and decide whether to sell or stay or hold your bond, okay? So FX currency, that is foreign exchange currency, is also a good determinant of how yields are moving. The greenback, well, we've always had, even as you listen to the news, they talk about the shilling against the dollar and at what rate it is. So if the shilling is weakening, there is always a likelihood that yields will go up, because basically it means that if you were buying a bond worth $1 million, now that $1 million, if it was 101, was worth 101 million shillings. Okay, let's use a better figure. It was worth, say, 10.1 million shillings. If it weakens, then that bond value is worth 10.7 million shillings. And that means that you would need you would be using more to buy that same bond. So the interest rates would be moving up, okay? These are technical terms, but not to worry. There's what we call inflation, and I think everybody has encountered inflation. Inflation is what wipes out the value of, the real value of your money. And if inflation of a country is going up, that is, if it's becoming more expensive to buy food baskets and things like that, then it means inflation is going up, and that's likely to affect the interest rates as well. So interest rates will go up in the event inflation is going up. Now, these are not the rate of movement of the inflation rate or the interest rate or the FX currency is not directly equal to the rate at which the yields will move. This is just indicators for your knowledge, okay? Where do we get this information from? As I had said, if you would like to know more, you can always visit the Central Bank's website on www.centralbank.go.ke, or the Capital Markets Authority's website, that's www.cma.or.ke. Always make sure your financial advisor or the broker that you're dealing with is licensed by the Capital Markets Authority, just to stay away from fraudsters, okay? The NSE is not only an exchange and an intermediary, but also a regulator. So you can always visit their website on www.nse.co.ke just to get any more information on daily or weekly statistics concerning bonds. CASIB, I mentioned, the Kenya Association of Stockbrokers and Investment Banks. You can visit their website to know who are the brokers that are licensed. And then information comes through media channels such as the news and the newspapers. And these are very good for you if you're looking to know more on which bonds to invest in and where they're trading, okay? So like I said, also you can talk to your financial advisors here at NCBA Investment Bank. We're always ready to answer your questions. What are the benefits of investing in a bond? They are safer. What do I mean? They have less likelihood of losing out on the capital invested. So you're able to preserve your capital, initial capital, by investing in a bond and holding it to maturity. Now, like I said, there is still a possibility of making a loss with a bond if you choose to sell it before maturity. So you have to be very, very well aware of how much you put in, or your initial investment of the bond, plus understanding the yields and the trends and the pricing of the bond before you sell a bond, okay? There are reliable returns through fixed coupon payments. So you are assured that every 6 months you will be earning an interest, unlike stocks which dividends are dependent on the discretion of the company's management, okay? Infrastructure bonds are a favorite due to their exemption from income tax. I think I've mentioned this before. Tax is only on fixed government bonds, but infrastructure bonds tend to have an exemption from taxation on their bond interests. So you can be able to earn a tax-free income. Then they tend to be fairly liquid because they're tradable on the exchange. So unlike real estate where you need to wait until you can get a buyer, for a bond, it's very easy. It takes only a few days for your bond to get traded and settled, and you have your liquidity or money, okay? So they are also less volatile in the pricing. The bond price tends to be less volatile than that of stocks on a day-to-day basis. Despite the fact that yields of a bond move and affect the pricing of the bond, they are not, the change in price is not as significant as that of stocks on a daily basis. For instance, the price in the stock market, you would find maybe a share like Safaricom could gain or lose up to 10% of its price within a day. But with bonds, the movement in yields are never significant. They're very minimal and marginal and gradual. So you are able to track the price of your bond. Then there are opportunities to make capital gains. Where there is movement in yields, then there is movement in price. And at the right time, you can be able to sell your bond at a profit and still be able to reinvest it. But now that comes with a risk, and we'll look at that. What is the risk? There is inflation risk of eroding the real value of your bond interests. Since the bond interests are fixed, then there is the aspect of inflation that could eat into the real value of your income flow. Reinvestment risk, like I said, should you sell a bond or when your bond matures, there's always the risk of where to invest the funds and if it will earn a similar or better interest. There's always that risk that the interest, the income could be less, okay? The exposure to interest rate risk, that is movements in interest rates, which affect bond prices. In the event you would like to trade a bond, that you would be exposed to interest rate risk. However, if you hold the bond until maturity, then you mitigate that risk. You forgo potential higher returns since your coupons are fixed. Unlike stocks, which offer variable dividends, and dividends can grow based on the growth of the company, bonds are fixed. So if you invest in a 10-year bond, then you will be earning a fixed interest for the next 10 years, and possibly you might lose out on the opportunity to earn more had you gone for a shorter dated bond or gone for a stock. Investment requires large sums of capital. Now, as you saw in the prospectus, the minimum amount of investment, initial investment for a bond is 50,000. But there's a way to mitigate this risk, and I'll talk about it in the alternatives or options that come about when investing in a bond. In order to be able to, if you have less than 50,000 shillings, you're still not doing off badly. You can invest in bonds. How? You can get exposure into bond investment if you choose a collective investment scheme. Now, these are such as unit trust or omnibus accounts. Okay, so unit trusts are offered by investment managers or investment banks that are licensed to do this. So please do your homework, read their prospectus as well, just to know the charges and fees that are being charged so that it does not eat into your return. Here at NCBA Investment Bank, we have wealth management arm that actually provides money market unit trusts, money market funds as a unit trust, which would allow you an exposure to bonds and various bonds. So the return is relatively attractive, but still you would need to read the prospectus and get to talk to a financial advisor just to better understand. The minimum amount is about 3,000 shillings. So you see, you're not left off just because you don't have 50,000 shillings. As I mentioned, the other option that you can use to invest in a bond is registering an individual CDS account with central bank, and opening a CDS account with a broker, or using a nominees account that is through a custodian. So for instance, if you are not here, if you're working in the diaspora and you would want to invest in bonds, you can do so through a custodian. And just do your homework, make sure the bank is licensed by the Capital Markets Authority. NCBA Bank offers custody services, so you can talk to our banks. I'd like to thank you all. This has been very good. Though I could not hear you, I could see the reactions on Facebook. And then I'll be taking questions. So feel free to chat your way and drop your questions on the comment section, and I'll get to it as soon as I can, okay? So let's see which questions are here. Okay, Somebody is asking, kindly touch a little bit on money market accounts and NCBA offers. Like I said, we have unit trusts such as the money market fund and the equity fund, as well as the dollar fund. Now, for more information, I would advise you to just log on to our website or get in touch with our financial advisors. For now, I'll take questions that are related to government bonds so that I'm able to tackle as many as possible. Okay, so let's see. Please advise on the current bond on the market, interest and maturity date. Okay, so currently there is no primary bond running, okay, at Central Bank. CBK issues bonds every month. So the last one just ended a few days ago, and it was a 7.5 year, which was earning an interest of 12%, and a 19-year bond with an interest rate of 13.2%. So next month's issue is likely to be announced within the next 1 week. So please be on the lookout on Central Bank's website for their prospectus. Okay, so somebody else is saying, please advise on the website page. Yes, I mentioned Central Bank website is www.centralbank.go.ke, okay? So, are all secondary market bond offers listed on the NSE? If a bond does not appear, does that mean no holders are selling? Well, all bonds issued by Central Bank do trade and are listed on the Nairobi Securities Exchange. If a bond does not appear on the bond price list, then it means it has not traded or it has not matured, and therefore it's no longer available for trading, okay? How can one sell treasury bonds if they do not have a broker? You have to have a broker, as I mentioned. If you want to sell at a profit or sell at a reasonable, at market price, you would need to trade in the secondary market, and that means you would need to open a CDS account with a broker. I would recommend NCBA Investment Bank. We offer such services. Okay, so there are two types of accounts. Like I mentioned, the CDS account that holds government bonds at Central Bank, then the CDS account at the broker, which facilitates trading. So though you hold a CDS account at Central Bank, you are not able to trade it unless you open an account with a broker. Only corporate bonds are held in custody by the CDSE, that's the NSE, okay? Let's see, which other question is there? So somebody says, I'm still struggling to understand the price versus coupon rate. I thought the reverse would be true. Okay, so like I said, price is affected by the yield, not the coupon. Okay, the coupon is used to calculate the interest that is earned by a bond every 6 months, okay? Or rather annually, but paid every 6 months. However, the price is determined by the yield. And if the yield should go up, then the price of the bond will reduce in value. But if the yield comes down, that is lower than the coupon rate, then the price of the bond will appreciate and go up. So there is an inverse relationship between the yield and a price. I hope I've been able to answer your question. Please explain to us total indicative investment amount. Please explain to us the total indicative amount. I think the total indicative investment amount is dependent on the price, okay? So when we say indicative, is because of the indicative price. So the face value of your bond, for instance, if it is 1 million shillings and is paying a coupon or an interest rate of 12.5, and then the price is, say, for instance, 102 for every 100, then it's trading at a premium. The amount that then you will invest is 1 million times 102 divided by 100, which would be 1,020,000 shillings, excluding other charges, okay? So indicative amount is based on the price of the bond. That's how you get the value of your bond. Let's see, what other questions are available? Does NCBA support clients in the opening of a CDS or central bank account process? Yes, we do. If you're a customer, we'll be able to offer you advice on how to fill in the forms and submit them to central bank, okay? So feel free to reach out to us. We offer client-specific, we are client-centric, and we'd like to offer specific solutions for your needs. So please feel free to reach out. Can a common mwananchi engage in investing in bonds? Yes, you can. As I mentioned, there are other avenues that you can use other than directly investing through central bank, and that is using collective investment schemes, such as our unit trusts. The money market fund offers you an exposure to bond investments without necessarily investing such large sums, but you can be able to invest as low as 3,000 shillings. When opening, let me see. What other questions there? Is there any other tax on FXD beyond the 10%? No, the 10% is only taxed on the interest that you earn on that fixed bond. Okay, so the maturing funds, once you hold the bond to maturity, the funds that are maturing, the principal value or the nominal value is untaxed. The only thing that is taxed is your bond interest. For a bond that is below 10 years, the withholding tax is 15%, and anything that has, and any other bond that is longer than 10 years, the withholding tax is 10%. I'm trying to pick as many questions as possible. So please bear with me if I miss out on yours. We'll still reach out to you and answer your question. Please guide on the best bond paying interest in January, July, or February, or August, at least with a tenor of greater than 10 years. Now, like I said, there is no such thing as best bond because it depends on your needs specifically and the bonds that are available in the market. Okay, so what matters is whether you're able to match your investment objective with the bonds that are available. For instance, you can look at the FXD1 2020-15, which has a yield, a coupon rate of 12.76%. And then you can compare it with another bond like the SDB 2011-30, which is a 30-year bond, which has a coupon rate of 12%. Now, all these bonds come so that you are able to find one that suits your needs. So please reach out to us so that we can be able to see what exactly you're looking for and find you what is available in the market so that you're able to meet your needs, okay, and objective. Thank you so much. If there are no more questions, I think, thank you. I appreciate those who are commending me for the presentation. And I would just like to say thank you to my team who have helped make this webinar a success. It's been a joy for me, okay? So in case you would like to hear more about this, please, you can just send us your emails to dealing, that is DEALING @ncbagroup.com, or investment team, that's one word, investment team @ncbagroup.com. And we'll be able to answer all your questions and hopefully find you an investment that suits your objectives. You've been a great audience, and from all of us here at NCBA, go for it. Thank you.
NCBA.